This is Matthew Cratter from Trader University, and today I want to talk about how the Fed continues to blow up the markets. We were talking about this yesterday, and we were talking about the comments from one of the Fed governors, Brainard, about how the Fed was going to shrink the balance sheet. And I said on Wednesday we needed to be prepared for the Fed's minutes to be released. Now, these were the minutes from the previous meeting, so the March meeting, and they were just released yesterday. And we got the news that Brainard's hints were true, that the Fed is indeed planning on shrinking their balance sheet by over $1 trillion per year. If you want to read the exact notes from the meeting, you can go here and you can click right here on HTML or PDF to see the notes. I'm going to show you the relevant phrasing here. Participants generally agreed that monthly caps of about $60 billion for Treasury securities and $35 billion for agency mortgage-backed. So Treasury securities are just US Treasuries or government bonds that are used to fund the US government, and then MBS or mortgage-backed securities, which are packaged up mortgages. And to the extent that the Fed buys mortgage backs, it helps to prop up the housing market, and it keeps mortgage rates low. So the fact that these are both being rolled off is indeed quite significant. If you're finding this video helpful so far, be sure to hit that subscribe and like button. So what the Fed is doing here, here's their balance sheet. These are all the assets that they hold. And we can see that they've obviously grown their balance sheet quite a bit since the start of the pandemic. The way they grow this balance sheet, as we've talked about many times, is they print up new money and then they buy assets with it. In this case, government bonds and mortgage-backed securities are the two really big purchases. Now, the Fed has shrunk its balance sheet in the past. It did it from 2017 to 2019, and it was a very bad time for the markets, and there was a kind of a mini S&P crash along with a lot of volatility. So I thought I would compare this runoff, this shrinking of the balance sheet, to what they did back then. So this time around, they're going to do approximately $95 billion per month. They may phase this in slowly, they said, or they may phase it in more quickly. I think if we get a real crash here, they don't end up doing much of it at all. But $95 billion per month of US Treasuries, government bonds, and mortgage-backed securities gets you to about $1.14 trillion per year. They currently have about $8.9 trillion worth of assets on the balance sheet. So that would be shrinking their balance sheet by approximately 13% per year. If we want to compare this to what happened in quantitative tightening of 2017 to 2019, quantitative tightening just means they shrink their balance sheet. Quantitative easing means they grow their balance sheet. But they were doing QT, quantitative tightening, back in 2017. They started with about $4.5 trillion worth of assets on their balance sheet. At the peak, they were doing about $50 billion per month, so $600 billion per year. So it's approximately the same ballpark, maybe a little bit more, 13% as opposed to, or 13.5% as opposed to 12.75%. But what happened during this period, especially 2018, was a very bad time. There was a lot of choppiness. We did hit new highs on the S&P 500 and then really plummeted at the end of the year. But it was a very difficult trading market. It was very bad for growth stocks and momentum stocks. And this is what happens when the Fed raises rates. So they had initially started raising rates in 2016. They raised them without too many problems. So in 2017, we had a banner year for the stock market. It basically went straight up the whole year. But by the time they got above, call it 1.5% roughly. So they raised interest rates by about a full percentage point in 2018. And by the time they got above about 1.5%, the interest rate tightening really began to affect the real economy and affect the stock market. By the time we got to 2019, the market figured out that the Fed was on hold, and that's one reason we had this huge recovery in 2019. Ultimately, that led to the Fed being on hold until the pandemic. So the market is always forward-looking. It tries to figure out what the Fed is going to do. Obviously, the hints it took yesterday were quite bearish, which is why stocks sold off. And I would expect them to continue to sell off, and Bitcoin as well to continue to sell off as the Fed tightens. But you can see here that they've only tightened a tiny bit, and the markets are already crashing because the whole economy is much more levered, and there's a lot more debt in the system than there was in 2017 and 2018. The Fed funds market, the probabilities for where we're going to end up this year has, so this is for the December meeting, the last meeting of the year. The consensus is really around 2.5 to call it 3% Fed funds rate. For comparison, we're currently at a quarter of a point, 25 basis points. So this is hiking quite a bit, hiking more than 2%, which is what they did in 2018. And this is beginning to get priced into the forward markets, into the euro dollars, and into Fed funds, as we can see here. But the big problem with this, and why I think the Fed is making a policy error, if we just do a back of the envelope calculation, the U.S. government is still spending running budget deficits of 2.3, call it 2.3 trillion per year. And we can only expect this to go up as more Medicare and Social Security benefits get paid out, as we maybe ramp up defense spending, and as if Biden's able to push through any of his increased spending plans, which we will see. The midterms are probably not going to go well for the Democrats, so this may not be possible. But it seems reasonable to assume budget deficits of 2.3 trillion. What this means is the government's spending more money than it's bringing in, so it needs to issue about 2.3 trillion in new debt. So this is the math problem that the Fed has, and the debt problem that the U.S. government has. They're going to be letting their balance sheet shrink by about 60 billion per month. So that's 720 billion per year, just of the US Treasury piece, not counting the mortgage-backed security piece, which would take you over 1 trillion, but $720 billion worth of debt, of US government bonds, of treasuries. They're going to roll off the Fed's balance sheet. They're not going to do outright selling, it looks like, but someone needs to buy this debt as the U.S. government rolls it. So the way the U.S. government works is it pays off maturing debt or expiring debt, you might say, with new debt. And so if the Fed is releasing essentially $720 billion worth of government debt into the markets, someone needs to buy that, in addition to the new debt, that new 2.3 trillion worth of debt. And it's probably going to be more. The government always spends more than we expect it to, especially if you start to run in hard times and they need to restart stimmy checks or stimmy checks for gasoline at the gas station, something like this. But if you combine these two numbers, the maturing debt that someone needs to buy with the new debt, you end up with about 3 trillion in debt that someone needs to buy to fund the U.S. government. And this will be issued by the U.S. government. Someone needs to buy it. And who's going to buy it? Even at these interest rates at 2.5%, are you willing to lock up your money for 10 years or 30 years for 2.5% or 3%? It's quite absurd. And we've seen that foreign and international investors, foreign holders of U.S. debt, really peaked in 2014, 2015. We spoke about this, and has since been moving downwards, with the U.S. And the EU confiscating Russia's FX reserves, with the U.S. running this very high inflation, 7-8%. It doesn't make sense really for anyone to hold securities that are yielding 2.5 or 3%, and this is why the Fed has really been the buyer of last resort. So this is the problem. We need to find new buyers. If the Fed's not going to do it, someone has to do it. And $3 trillion is not really something that I don't think the U.S. banking system can absorb this. I don't think the U.S. private sector can absorb this. And so there's a real problem. The bond market is sniffing this out. This is why interest rates are spiking. The 10-year has just gone straight up, trying to find a clearing price at which we can entice more foreign and international investors, whether it's foreign pensions or endowments or even foreign central banks. But the problem is, if you're a foreign central bank and you've seen how we've treated the Russian reserves, you're not going to want to hold U.S. Treasuries, because they can just be turned off and confiscated if the U.S. gets mad at you. So this is the real problem, and the problem is the equilibrium for this rate is much higher, I believe. If you have CPI of 7 or 8%, you really should get U.S. Treasury rates above 7 or 8%, so you have a real yield. It doesn't make sense to be earning 2.5% on the coupon and then losing 7 or 8% on the principal in terms of purchasing power because of such high inflation in the U.S. So this is the real problem. This is why the markets they're already buckling under the strain of higher interest rates. Housing market is going to start to feel these strains too, as the 30-year fixed has moved from 3% last year up to 5%. This is a tightening across the board, a tightening against housing, against risk assets like stocks. And it looks like this is going to keep moving. This is going to keep happening. The Fed seems content to do this, but I think they will be forced to reverse course, as I've said many times. At a certain point, things really break, whether it's the financial plumbing, whether it's some sort of repo crisis, whether it's some other obscure crisis in another part of the US financial plumbing, or a stock market crash, which we're already really beginning to see, or a recession. The Fed at that point will be forced to reverse course. And that's really what happened, what we saw in 2019. And we saw the reversal there, and the stock market sniffed it out and proceeded to go much higher. But until the Fed does that, they are definitely making a huge policy error here. Inflation is a big problem. Obviously, it's bad for everyone, but the Fed has really painted itself into a corner, and the only way out for the U.S. is to inflate our way out of the debt. So the Fed is trying to play tough guy here, and it's not going to work. They're going to end up crashing asset prices. Then they're going to have to turn back on the money printers to mop up the mess that they've created. And this is what's really crazy about the current system. The Fed makes a mess, and then the Fed comes in and cleans it up. But the real culprit here is U.S. government spending and how that needs to be funded. Our central bank, our Federal Reserve, is ultimately going to monetize all that debt. And this is really what eventually leads us into the regime of not just inflation, but hyperinflation, and the failure of the U.S. dollar as the world moves to a different reserve currency or multiple reserve currencies. And obviously, I believe Bitcoin will play a large role in being that new world reserve currency or world reserve asset. In the meantime, expect very high volatility. We could see sharply lower asset prices and a lot of really choppy, messy trading. So I remain on the sidelines in terms of momentum stocks, but I'm certainly continuing to buy Bitcoin as I have cash available to do that. That really is the place to hide. We could still see a sharp drawdown in Bitcoin, but when the Fed reverses course, you're going to see new highs on Bitcoin, and this is how we're going to get into the hundreds of thousands of dollars and ultimately millions of dollars per Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video, and let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.